Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. I'm so glad you're here. What do we got going on in the markets today? Well, we're having a booming day. The Dow's up almost 300. NASDAQ's up about 200. We're off to the races again. Now, what's happened is we've gapped up to fill the gaps. Now, coming down, we had the gaps. A gap just means that the price you close at, you gap up either down or up. It could be either direction. Today, we've got a big gap up, but recently we had those gaps coming down, and then we gapped up to fill those gaps, and now the gaps are below us again. I think this is a topping out process. Now, a lot of you think this is a new bull market. The S&P, it's sitting around, 4450, only off about 250 points from its all-time record high. Now, if we get there, I'll be a little bit surprised. That's a fact. I think we're going to come back in. I think this is a topping out process. Look at Apple Computer, $3 trillion. $3 trillion. Now, I don't have the exact numbers here, but it took them something like 50 years to get to 1 trillion, and then it did 2 trillion more in like less than 10 years. Anyways, Apple Computer, first $3 trillion publicly traded company. Are all you going to run out there and you get those, what are they, $3,500 for, I don't know, that provision thing they got coming out? Oh, Apple's fascinating. A lot of people think it's going to take off from here. I do not. I think once Apple starts to roll over, the market's going to start to roll over, but it's not rolling over yet. So maybe we're still got a little bit more upside. It's a topping out process. I do think we're going to come back down, though. I think the market is going to come back in over the summer months, over July, over August. Now, we've had a great June alone, right? Okay, we are up on the S&P 4.6%, 4.9% on the NASDAQ. The NASDAQ's up about 30% for the year. The S&P up about 15% for the year. Anyways, this market has been strong. It's been very resilient. Look at inflation numbers come out. Inflation's going away. It's going back down to zero, right? I don't believe that, but maybe it is. Maybe it is. GDP numbers come out. Those are up. Oh, GDP's going up. I don't believe that either. But anyways, I do believe the market will come back in. Just my take. Let's get over to the real estate market because we got some things to cover. All right. Let's talk just for a little bit about the luxury end of the market. The luxury end of the market. Now, if you live in LA County in California, they put this mansion tax out there, okay? So if you sell a property over $5 million, there's a 4% tax. 4% tax. Over $5 million, a 4% tax, okay? Now, 5.5% tax over $10 million. Now, mark my words, this is starting in LA County. Now, eventually this will go to all of California, and it won't be for $5 million properties. It'll be down to $1 million properties. It'll take time to go that way, but once they got the law instated there, they'll spread it out to all of California, and then they'll lower the amount down to $1 million houses. Okay, so there'll be this tax coming on houses. But what has this done to the luxury market? Well, the whole luxury market is really crashing. Okay, 50% off on volume already. On volume, okay. All right, so anyways, Mark Wahlberg goes out and lists his mansion in LA. Okay, $87 million. $87 million. Well, he kept reducing the price. He finally got $55 million. So listed at $87 million, he sold it for $55 million. Okay, a 37% discount. Now that's a big price cut in my opinion, but 37% discount on his mansion because the luxury market, it's stuck. Nobody's buying. Now Rod Stewart, he just came out and he put his mansion up for sale, $70 million. Now I love this. This has 2 points to be made here. Rod Stewart, he's not going to take a penny less than $70 million because he feels it's worth it. Look, at the seller doesn't dictate the price. It's the buyer. What's he willing to pay? Now, Rod Stewart, he doesn't have to lower his price 1 penny. I agree with that. But it's not going to sell for $70 million. It's going to come in. It's going to come down. He's going to have to discount that if he wants to sell the property. Now, how old is Rod Stewart? Well, I had to look that up. I thought he was 80. He's only 78. 78. Only 78. But this is my point, that the baby boomers are getting older. Now, he's probably at the front end. I'm probably at the tail end of the baby boomers. But do you remember when baby boomers were retiring? 10,000 a day at the peak. 10,000 baby boomers a day were retiring every day. Now, soon, there's going to be 10,000 baby boomers dying every day, and that's probably about 5 to 10 years away. When that happens, there will be so many homes flooded onto the market that 50% off sale is going to be nothing. It'll be much worse than that. But we're going to get there before that point anyways. Now, why are we going to get there before that point? Now, I keep talking about forced selling. They're going to force people into the marketplace. Now, you say, but Mike, what's going to force the people to sell? They got that 2.8% locked in for 30 years. They're not going anywhere. All right, now that's not what forced selling is. Forced selling is when you lose your job, for example. Now, we're going to talk about that. But people have overextended themselves. Even at the 2.8%, they bought more house than they can afford. 63% of people have buyer's remorse that regret their purchase if they bought in the last 2 years. 63% because they're overextended. Now, what happens when you're overextended and you lose your job? Well, then something happens. You can't make your mortgage payment. You're going to become a forced seller onto the marketplace. Okay, so there's going to be people forced to sell their houses. Now, what people don't understand is we're going into a recession. The administration will tell you there's no way we're going into a recession. Never going to have a recession again. You see, a recession is actually a good thing. It flushes out bad investment. Malinvestment gets flushed out. It cleans out the system. You need to have recession. But this government, the Federal Reserve, they think that we can just print money forever and never have a financial problem again, never have a recession again. Modern monetary theory says we can just print money into oblivion. Maybe we can, maybe we can't. I say we cannot. All right, but okay, so people are being forced to sell their house. This is what's coming. There's going to be forced selling. But here's what people don't understand. Here's what people don't understand. When the layoffs come, and they're coming right now, about 1 million a month right now, but that's going to pick up probably to 2 or 3 million, and probably by the end of this year, probably in the next 6 months, that's going to happen. But Mike, the numbers just came out. The GDP went up, not down. Take my word for it. We're going to get a negative print on GDP this year, and it'll probably be the end of this year, beginning of next year, where there's going to be this big recession. Okay. Anyway, so the recession comes, people get laid off. Now, here's what they don't understand. When someone gets laid off, okay, it's not just the seller that has to sell, right? He gets laid off. He's got to sell. But here's what also happened. The buyer got laid off, and the buyer's forced out of the market because he doesn't have a job. One time I had a client, we were set to close. 2 weeks before escrow closed, he lost his job. That deal fell apart because he didn't have a job, couldn't buy the house. So not only is the seller going to be forced to sell, the buyer is going to be forced out of the market. So there's not going to be anyone to sell to. The seller has to sell, but there's no buyers left. Okay, this can happen really fast. It can happen a lot faster than you think. It can happen very quickly where the seller has to put his house on the market and all of the buyers are removed. So what happens to the prices? Prices come down really quick, 10, 20, 30, 40% like that. It happens fast when it happens. But that's what's going to happen when the recession hits, when the layoffs hit. All right, she's saying, Mike, you're just talking crazy stuff. Now, for people that get a little afraid here, you might want to just change the channel right now. I'm going to talk about some things that happened over this week. Number one would be the stress test on banking system. Okay, stress test on banking system. 23 banks were stress tested. Guess what? They all passed. It's incredible, right? So you got the Federal Reserve, and they're stress testing these banks, but they're in cahoots together. Of course they all passed. If they didn't pass, they wouldn't even make an announcement about it. Believe me, the test is an easy test, and the banks passed. I don't believe that the banks passed. You see, here's the thing. Remember when the Federal Reserve got caught red-handed for insider trading? They'd come out with their announcement. They would trade ahead had an announcement and they'd make hundreds of millions of dollars. Well, here's what they did. They said, don't worry about it. We're going to investigate ourselves. And they went and they investigated themselves for doing insider trading. And they came back and told the public that, hey, it's okay. There was no problem after all. You got, this is just wrong. They can't do the stress test themselves. They got to get an independent company to do these. They can't just monitor themselves for day trading. Look at it. Me and you got caught day trading. We go to jail. Day trading, insider trading. We are allowed to day trade still, but we cannot do insider trading. That's what the Federal Reserve was doing. So they got caught red-handed and nothing happened. They investigated themselves and we moved on, right? All right. So the banking system is completely safe now. The three largest banks, the 3 out of the top 30 banks, they went down hard, and they were all stress tested. Nobody saw this coming. Nobody saw those banks failing one after the other. I'd start with Silicon Valley Bank right here in my area. All right, First Republic Bank went down. All right, and the Signature Bank went down, and there's going to be a lot more banks going down. There's going to be this consolidation in the banking system. Why is that, Tall Mike? Well, because all of the banks are doing the exact same thing. They're making loans out there okay, for example, just home loans. Okay, 3%, 2.8. I got 2.8. So they make that loan for 2.8, but they can't get the money back in. Now they have to pay 5%. If I go to my bank, I can get a 5% certificate of deposit right now. That's what they have to pay me to get my money. They no longer have the money because all those loans they made at 2.8, the mortgage rates are up at 7. So those loan values came down 30, 40%. So the banks are running out of money. They're desperate for money. So they're paying 5%. Now, I don't know how they're going to make money on 5% because they're going to loan it out at 7% to people, right? Well, okay, what happens when those people don't pay? Look at here. Let me talk about some people that aren't paying. Let me talk about the commercial real estate end of things. $20 trillion market. Just in the next year or two, there's going to be about $2 trillion coming up that needs to be refinanced. It needs to be refinanced at a higher rate. It was 3% when they got their loan. Now it's 7 or 8% for the commercial loan, right? So they got to refinance, but their building's half empty now because everybody's working from home. Building values are down by over 50%. San Francisco had a building they bought for $300 million, just sold it for $60 million. That's 80% off. Now here's the problem with that. Property taxes on $300 million is a lot of money. On $60 million, it's a lot less money. The big cities, San Francisco, New York City, they're not bringing in enough money in property taxes. What are they going to have to do? They're going to have to tax their residents. They're going to have to tax me and you. They're going to have to find ways to raise that money back up. People are buying the buildings, but they're buying them at 80% off. Look at Brookfield. They're a big developer, right? Okay, they just gave back 12 office buildings, just handed the keys back. It's called Jingle Mail. You put the keys in the mail and you send it back to the bank. Jingle Mail is back with commercial real estate. All right, they had 8 malls. They gave the malls back to the banks. These banks are holding this stuff. Westfield just defaulted $548 million. That is a mall right here locally. 80% off on these towers. Okay, so you got commercial real estate as a problem for these banks. But these banks have a bigger problem. It's called zombie companies. Zombie companies. Now, we're in this stock market rally here. I mean, the market is going up. It's going up. Apple Computer leading the way. NVIDIA leading the way. Here's what they don't tell you. In the Russell 2000 companies, okay, 42% do not make money. 42% of the companies are losing money in this booming economy. How's that even possible? That's over 800 companies right there that are losing money. Okay, so they have a problem now. These are called zombie companies. Zombie companies. Not all 800 are zombie companies. Let me quickly explain what a zombie company is. A zombie company is a company that doesn't make money. They don't bring in enough revenue to even pay the interest on their debt. Corporate debt is at record highs. Corporate debt has to be rolled over. It's not 30-year money. It is short-term money, 2-3 years. It has to be rolled over. Now, these zombie companies, they have to go out and they have to borrow more money just to stay in business. Now, here's the thing. If you owe the bank $1 million, you have a problem. When you owe the bank $1 billion, the bank has a problem. A lot of these zombie companies have borrowed billions of dollars from the bank, so the bank doesn't want to let them fail. They want to keep them in business, hoping that they can turn the company around, even though the company should be washed out. You see, that's the problem with this modern monetary theory where we just print money into oblivion. It doesn't give time to wash out the bad investments. We have to keep those bad investments alive. In the S&P 500, 20% of the stocks are zombie companies. They don't bring in enough cash flow to make their payment on their debt, so they have to borrow more and more money. Now, when they were getting money at 1 or maybe 2%, they were able to survive. But now they have to get money at 5 or 6%, and they're not going to be able to survive. At some point, we have to have that recession. That recession is going to hit hard because there's a lot to flush out in this marketplace, right? All right, so what are all these companies doing? Well, they're buying back their own stock. They're buying it back with money borrowed at, the 1 and 2%. But now that money's drying up. They have to borrow that 5 or 6% now from the Fed, right? All right, but they're still borrowing money. They're still trying to stay afloat, and the banks are still making these loans to the companies to keep them afloat because these companies owe the bank billions of dollars, and they want to keep that company alive in hopes that they can get their money back, that they don't have to write that down as a loss. They won't want these commercial properties to sell because they would have to mark them to market. See, right now they can keep that commercial property if it's not selling. If they don't give the keys back to the bank, they can keep it up at the $300 million level when it's really worth $60 million. They don't want to take that $240 markdown. It's called mark to market. Okay, eventually this is all going to flush out. And believe me, it'll probably be a good thing when it does. And when this flushes out, the banks are going to seize up. You're going to see this is just an off-the-wall prediction, but I think you're going to see one of the major banks go down. I don't have any names throughout. I'll throw out names. The major ones are Wells Fargo, the B of A, Citigroup, even J.P. Morgan. What if any of those go down, the whole system comes down. Those are the too big to fail. But you're going to see bank runs. You're going to see one of the majors go down, and it is going to bring everything down to a credit crunch. You think your house is going to stay up here? You're going to be lucky if it's only 50% off. Now, I didn't mean to scare anybody on a Friday, but I just get, sometimes I see the comments in the comment section. It cracks me up, Okay, here was one of the comments. If you're waiting for prices to drop on your house, I feel really bad for you. If you're waiting for the prices to drop so you can come in and buy one, this gentleman feels really bad. Well, you know what? If you go out and buy a house today, I feel really bad for you because you're going to be what's known as the bag holder. Anyways, I'm Tall Mike. It's Friday. Didn't mean to scare anybody. Sometimes I do that on Friday. Get out there, everybody. Have a great weekend. But first, give me the thumbs up. Why not tell your friends? Bring them to the group. Maybe we can educate them. Anyways, get out there. Have a great weekend. Bye-bye now.